First, just want to say thank you to everyone who's joining us today to let you know I'm recording so we can continue to make this session available as um, the broader Life After Wellesley series. If you're interested in checking out some of the other content that we have as part of Life After Wellesley, which is intended to provide support to seniors in their transition from Wellesley to whatever comes next, but also is certainly applicable to any student. We have some topics on how to find housing, how to build community once you leave Wellesley, how to maintain your wellness, and have a couple other topics that will be thrown in there as well. So feel free to check that out. You can check that out at the Career Education website. So I'm going to pass it off to Jamie Easton. Thank you so much for sharing your time and your expertise with us, and I'm excited to learn from you.
Great. Hi, everyone. I'm going to share my screen before we get going. Okay, hopefully you all see that. Okay, perfect. All right. So thank you so much for having me tonight. As I said, I'm very happy to be here, especially on a night where, where it's nearly 7 degrees in New York and warm in Boston, and there's a lot of other world news going on that is also drawing our attention. So thank you for giving me some time tonight. For many of you, post-graduation is probably the first time that you're fully on your own and paving your way financially in the world. For others, you probably have already begun to manage your finances, but I think it's always critical to pick up some new skills along the way, and hopefully you'll find this incredibly helpful. I was once in your shoes, and I hope to pass along some actionable post-college advice, and also, we can talk about some fumbles and mistakes along the way that hopefully you can avoid. So let's see here. Okay, so April, I figured that this is actually the perfect time to do a session like this. April's actually National Financial Literacy Month. So we're gonna end the month on a high note and take on this important topic. So we learn so many skills throughout our educational endeavors, and we learn how to read, we learn how to write, think critically, analyze data, and we master things like geometry that we don't, most of us won't even use post-college. But when it comes to traditional education and really learning financial literacy, there's not that much room for it. So how are we really supposed to learn? And unfortunately, the training has to really happen in real time. So the best news that I can give you right now is that you're all young and you have a very long and, hopefully successful career journey in front of you, including your peak earning years. So why is that so important? Well, the whole key to financial wellness is to start saving and investing early. And one of the most powerful tools that we'll talk more about, it's going to be your new best friend, and that is the power of compounding. And when you start investing and saving early, we're going to get very familiar with this power and why it's so great to be talking about these things when you're in your 20s. So we are going to do a couple things today. First, I'm going to tell you a little about me and also my brand, The Uptick. Then we'll cover why I'm so passionate about financial literacy. We'll talk about how to even get started in the world of investments, and then we'll talk about the markets today. I will be sure to leave you with some good tips as well. Okay, so here's a little bit about me. I'm Jamie Easton. I'm founder and CEO of The Uptick. It's a media business aimed at empowering women to better understand business and finance. I spent a 20-year career on Wall Street before becoming an entrepreneur. I graduated from University of Pennsylvania, and I majored in economics and political science. I then went on to Goldman Sachs, where I was a junior analyst in equity research. So I really spent the bulk of my career in equity sales. I didn't really love equity research, but I did love the fast-paced environment of being on a trading floor. I was also fortunate enough to have the opportunity to run investor relations for a publicly traded investment bank called Evercore. So I had a phenomenal experience on Wall Street, but I had this burning desire to do more outside of Wall Street and more about educating women in financial education. And ultimately, I really wanted to impact how women interact with business news because I found that to be an area where women really decided to shy away from and avoid. So I did try all of these different women's initiatives through my time at Wall Street, and I felt like I was spending a lot of time helping women that were already in finance stay in finance. And yet there were so many highly educated women in all of these other professional sectors that really knew nothing about finance. And I found that as they get further and further into their careers, the further they got away from ever doing anything to change it. So I was actually at a dinner party in late 2019. No, it was probably late 2018, early 2019. And this idea sparked that I should leave Wall Street. And I was sitting with a few couples, and the topic of business news came up, and the women turned to me and they tried to change the conversation. And they said, "Oh, so what else is new?" And this struck me as crazy. And I said, "You know what? Why in every other aspect, every other piece of news that comes out, women have a voice and they're happy to add to the conversation. The second it changes to business or finance, I'm met with the what else is new?" And I found that it was really a lack of confidence to really participate in this conversation. And I started doing a little research, and the more I dug, the more I found that, this lack of getting involved in business news and finance kept women shut out of making other financial decisions in their life and trying to offload these decisions to their partners, and oftentimes having men in charge of their financial futures. When I did start asking women, why are you not talking about this? And I would get answers with, "Oh, I was an art history major," or "I'm bad with money." And I think that mindset really has to start shifting, and it has to start shifting with women your generation. So this is my product. I come out with a weekly newsletter, and I launched just right before COVID. And the whole idea and the premise behind what I do is that when women start conversing more in finance, it opens up doors to really rich and important conversations that ultimately impact their financial futures. Okay, so now let's talk a little bit about financial literacy. So the one thing I will leave you with, and what I hope you will do, is that you're going to start following financial news from the outset. So let's talk a little bit about what's going on with financial literacy. So it's actually shocking for me to see when I look at the statistics, even in 2021, how women are faring relative to men. So women account for 51% of the US population. And when you look at the surveys, 26% of women have money invested in the stock market compared to 60% of men. So in fact, it's 65% of women have a large percentage, have a large percentage of their money in cash, and 41% of women have no plans at all to invest their cash. So is this a big deal? It absolutely is. So let's talk about just different investment options that women are presented with, or everyone's presented with. But the first one is under your mattress. And I hope that you all know that this is not a good option for you to, ultimately put your money and grow your wealth. And not only, and I don't mean under your mattress, I mean in your wallet. And why is this a bad idea? Well, first, if you have $100 to invest today, if you leave it in your wallet under your mattress at the end of the year, you will still have $100 if you don't lose it, right? So then the second option is taking that $100 and putting it in the bank. Is that a great idea? Well, on the positive side, if you put the $100 in the bank at the end of the year, you'll have maybe $100.05. And it will not be lost, right? It's FDIC insured, so it will still be there. it's definitely a safe place, but are you really growing your money? Is your money working for you? Absolutely not. So then you have bonds, and investing in bonds has been slightly better than the cash alternative, but it still really pales in comparison to stock returns. Bond investments yielded an annualized, 5% over the past 10 years. And then we have stocks, and stocks are really the most alluring and exciting of the group. And it lured me in when I was young. I spent, the bulk of my career in Wall Street, in this fast-paced world of stocks. And looking over the last decade or even the last century, the stock market return has been over the last century 10% a year. And sure, you have some years where markets are down. You have some years where the markets are up well over 10%. But stocks are really just about the best place for a younger investor to put money. So let's add a little perspective here. Let's say we had a $5,000 investment that we made in 2010. What would it look like today? So the stock investor now would be sitting with $18,000. The cash investor that put it in a yielding account or a CD would have $5,300, and the bond investor would have a little over $8,000. So while stock returns are absolutely more volatile, and they do vary widely from year to year, stock investing is truly very compelling and a great and far exceeded the performance of most other asset classes. Okay, so given all of these alternatives, why do women, you see these statistics and you're saying, well, this makes perfect sense. Why do women continue to steer clear of stock investing? So, our reluctance to really invest impacts our financial futures. The severity of the investment gap is really compounded with the wage gap. So if women make about 82 cents for every dollar earned by men, in the best case scenario, and that number does go down for most minority women, it leads to women only realizing retirement balances that are half the size of men's, which is really that's really shocking, right? Because women get to be a certain age. Men are just better set up to, handle their retirements than women. And here we go. And let's talk about really dig in why that is. So if investing in the stock market makes so much sense, looking at historical returns, women are staying away in part due to our reticence to really lean into the market and embrace, that they're going to put their hard-earned money into something that's a little unsettled and not guaranteed. So, if you hold cash in the bank, it's FDIC insured if there's no risk. Treasury bonds are backed by the full faith and credit of the US government, not really a risk. But the stock market is fraught with risk, and particularly in the short run. The other thing is, when you look at trying to even get started in looking at stock investing, the market, the stock investing, it seems very inaccessible. And that's because when you look at all of these headlines, there's so much esoteric terminology, and it really becomes this unspoken barrier to entry. And looking at some of these headlines, right, it sounds truly unappealing and incredibly boring, right? So that riveting article on the dovish Fed, who's going to actually pick up that article and read it and say, oh, wow, this looks great. I'm going to see how this impacts me. All of this just really doesn't draw in the reader, and it's written in a way that makes it that barrier to entry that you're not going to get involved. So although investing does come with its own lingo, investing doesn't need to be complicated, nor is comprehending the markets as hard as it sounds. And let's see, there are a bunch of resources, and we can talk about that to support you on your journey to understanding financial news, and hopefully the uptick will be one of them at the end of this. So So here's the good news. Business news and understanding finance does not need to be complicated. You do not need to be a millionaire to invest money in the market, and you don't need to be a financial guru to make money investing and buying stocks or bonds, but you do need to learn how to invest. So people always ask me, what is the best way to actually start? So, I find that having a little bit of skin in the game is going to make you pay attention more and make you learn more. So, what I'm encouraging you all to do today is to buy stock. So, I'm not saying put all your money in the market. You have to understand, right, that stocks do go up and stocks sometimes go down. And what I am saying is you have to invest in the long term, but owning a single share of something is going to help you learn more, pay attention more. If you buy a single share of something, you'll actually care how that company does. You'll start talking to your friends more about this company and the investment, no matter how small it is. How, when you see a news article related to it, maybe you're going to start to read it. You see that they reported earnings, maybe you'll read and follow. So, I do challenge you that when you end 2021, you not only end with your favorite movie or your favorite book, I challenge you all to end with your favorite stock. So let's talk about, owning a stock. So what should you buy? It really doesn't matter, right? It doesn't, what we talked about is it doesn't need to be a huge investment. We're talking about a share of something. Where do you find the money to invest in the market right now? I mean, you can give up on a couple things to have some money to invest, and you can even buy a stock that is, $5. It doesn't matter what it is. The point of, and these Coinbase and Apple, I'm giving you just as examples. I'm not telling you to go out and buy these. And sorry, this ticker is wrong. It should be COIN. So owning one share of anything is not going to make you a millionaire. The purpose of this is to just really get your head in the game. So I actually got interested in the stock market in 7th grade. I had to pick a historical event in the 1920s to research. And I don't know how I picked this, but I picked the stock market crash of 1929. So after I started researching the markets, I thought it sounded really cool. And at the end of it, I decided that I was going to buy a single share of PepsiCo. I believe at the time it was around $18. Now, had I held on to it, I would have made 1,000% on my investment. That would have been really good. I didn't. But I will tell you that my interest in PepsiCo, my following the news, it was really a gateway to growing my excitement and my enthusiasm and my interest in the markets. And then I wanted to buy more and get more and more invested. So hopefully, and like I said, it doesn't matter what it is. It should just be a brand that you find interesting, that you care about, and you can start, gaining more confidence in your voice when talking about the company. Okay, so one thing, don't invest money that you're unwilling or unable to lose. And, don't expect the markets to continue to go straight up. I think that what is most terrifying sometimes is when you see markets so volatile or you see a crash like we did March and April of last year. And the first instinct is, oh no, I have to get out. If you do need patience and you do need to kind of, if you buy companies that you believe in for the long term, you're going to have to take the bad with the good. So, okay, before we go into the stock market investing, you need to figure out where to find money even to invest when you get those early paychecks. Because I think a lot of people say, wait a second, this is my first full-time job out of college. I'm really going to have no extra money to invest in the stock market. So you do need to live. You need to pay your bills on time. In the interest of time today, we're not going to talk about, debt and student loans. But I think, some of you will absolutely, some of your money will go towards paying down your debt. You do have to look at your interest rates. which we'll save for another time. But not all debt is bad. It depends on what the rate is that you're actually going. It's high interest rate debt that's bad. But what I will tell you to do is, regardless, and even if it's $20, you need to force yourself to save. So what I did, starting with my first paycheck, is I had it hit my direct deposit, and then I had another account set up that pulled $20 out of every paycheck into a separate account. So it never hurt my bank account. It was almost like I never got it. And as you get promoted, you get you get a raise, you can continue to increase the amount of that forced savings, but it is a phenomenally good practice. So I started doing it. I raised that 20 to 50, that 50 to 100, and eventually, that 100 to $250 that I kept pulling out. And I think a couple years in, I decided to take all of that savings account money and put it in the market, which was phenomenally helpful. And then when I got married, I had my husband do the same. And ultimately, it did become a down payment for an apartment. So it does work, and it does grow, and it does compound, and it absolutely works. Okay, so. All right, so now that we have some money that we found to invest, where do you even put your money if you don't know a lot about stocks? So this is more good news for you, is that you probably know a lot more than you think, and you possess enough knowledge right now to invest. So how is that possible? So when I first started in my job in equities, I said, I really want to understand, why do stocks go up and why do stocks go down? And my boss turned to me and he said, well, they go up because there are more buyers than sellers. They go down because there are more sellers than buyers. Is that true? Yes. Is that helpful? No. So I'll tell you, so stocks really move for three main factors. One, it's definitely the fundamentals, and the fundamentals are the numbers. It's what you see when you hear, about valuations and revenues and PE and all of those technical terms that that are thrown around in earnings reports. Those are the fundamentals. And when you analyze the fundamentals, you're actually analyzing the numbers. Are they important? Yes. Are they everything? Absolutely not. Two, you'll hear about some people that look at the technicals, and the technicals are really the charts. So some people read the charts and they say, because of the patterns and how things have traded in the past, this is what they predict for the future. Are the charts important? Sure. Is that the total picture? Absolutely not. So what is it that, even the best investors don't get all the time, and this is why they get stocks wrong, and that's sentiment. And sentiment is, understanding, how do people think and feel about the product or the brand or the company? And that's something that you absolutely know right now. And that's also, if sentiment weren't important, right? Stock analysts and hedge funds and mutual funds, they would always get everything right. And the reason they don't is because they're not always capturing sentiment. And, I think probably a lot of you had either friends involved in all the GameStop, or you read about it, all the craziness and the frenzy. That was all driven by sentiment and not driven by the numbers and the fundamentals. Okay, so let's talk about, it's really also an area where you can do your most investigative work. So the brands that you interact with every day, you have to think of them as businesses, and you have to think about, what are your friends saying about this brand? What's the staying power? Are people shifting? One of the best examples I can give you is, I worked with an analyst that was one of the best footwear analysts that I ever encountered. And he just had amazing stock picks. And I said to him one day, John, how do you pick your stocks? I feel like you always get it right. And he's like, oh, that's easy. When everyone takes the subway and they're looking out the window, I'm looking down at everyone's feet to see what they're wearing. And when I see what the young people are wearing, and I see when they give up on one shoe and then they buy Air Force Ones, I'm paying attention to the feet. And that's really what I'm telling you to do today, is that you can have an opinion and a voice about stocks just by talking about trends you're seeing and noticing things early. So let's talk a little bit, couple examples. So, Disney, if you look about at how Disney did, this is the 1 day chart. I'm so sorry about this. So if you look, Disney actually had an incredible run. This was supposed to be on the 1 year. It had an incredible run from last April to today, and the stock has been just straight up. In contrast to today, it traded down a little bit. But why did it trade up so much over the past year? Well, it launched a new product. It had crazy subscriber growth of Disney Plus that just exploded, and it became, nearly. It's catching up to Netflix, and Netflix has been in the streaming business for 13 years, and Disney Plus 18 months. So I think that, coupled with this hope and optimism about the theme parks reopening, really drove the stock. It's trading not at its record high, which was its 52-week high was $203. So it's trading down from that. But still, if you look at what the low was, I guess last year at this time, it was 98.86. So yes, an absolutely impressive performance from Disney. Then you look at something like Zoom. Zoom is, replaced our in-person classes. It replaced our in-person meetings. Without COVID, I would probably be there tonight live, and instead we're using Zoom, and it's so popular that it became a verb. Now Zoom, over the past year, if you look at the 52-week high, it traded almost to $600. It's now at $319. So why has it gone down so much over the past year? It actually went straight up from the start of the pandemic till about November, December. And from November, December, it actually has fallen a lot. And the reason is, the markets tend to look at how things are going to be doing in the future rather than how they're doing right now. So if you look to the future, if you're looking 6, 9, 12 months, would we be doing this meeting like this, or would we do in person? Are you going to go back to classes? How much Zoom are you going to be using next year? And I think what a lot of investors are saying is that, the in-person is going to return. And that's what we saw, the sell-off in the stock. So let's go to the next slide. So I love the idea really of focusing on the single stock idea to help you engage and learn more. And I think that beginner investors do need to diversify. And I don't think that you are absolutely going to be able to diversify by picking one share of something and learning from there. So the best advice that I would give you of where do you put the rest of your money, and that would be through index funds or ETFs. And what index funds and ETFs do is they give you exposure to a basket of stocks, and you can pick, something that mimics the whole stock market. You can pick something that is just technology or just energy, and you can get a little bit more narrow. But it does give you that access to own a basket and really diversify. The problem with it is I don't think that anyone gets that excited about owning an index fund that they're really engaged in markets. So, if I had, my $100 to invest right now, maybe I would take $40 and I'd put it into my stock, and I'd take the rest and I'd put it into an index fund or an ETF. But I definitely would make sure that the bulk of my money was in an index or an ETF. Okay. So then the other thing I just wanted to finish with before we go to Q&A is just when you enter the workforce, you're going to be presented with the ability to actually invest in either your employer sponsored 401k plan or a traditional IRA or Roth IRA, which is not employee sponsored. What I say to do that, and the reason why I talk about this now is you might actually get this on day one of your first job. And it seems like it seems like it's very early in your career to actually start talking about retirement. But what I will tell you, because of that power of compounding your money, I would absolutely say yes. You should say yes, because a lot of employers will also offer matching plans. So that means that uh, if you put a certain percentage of your earnings into the 401k, they would match it dollar for dollar in many instances. So if you say no, you're actually leaving a lot of free money on the table. There is a cap of 19,500, which I think is a lot for anyone out of college to actually think about putting into a 401k. It can be a very small amount. And as you get more and more senior in your career, you can contribute more and more. So that shouldn't scare you away. What I would tell you is, just try to contribute so your employer would actually match you. And if you don't have a matching plan and you need to wait a year or two before you do it, that's fine too. But I'm just saying that the younger you start to think about retirement, because of that power of compounding, it's really very important that you do it. Okay, so let's talk a little bit about the markets today. The markets today, and I don't mean just today, but over the past year, have had this incredible rally. And that rally is really all driven by, remember what we said about the market looking 6, 9, 12 months ahead. The market is really excited right now. And while you have days that are going to be down and there's a little bit of pessimism in there, I think overall, the most of Wall Street is really excited about what the future looks like, because they think that the consumer is armed and ready to spend. And there's a lot of pent up demand. And that, came from people, being armed with stimulus checks, people armed with just extra savings because there were no nights out at dinner, no money spent in entertainment, no money spent in travel, and people are really armed and ready to not invest and ready to spend. So when that happens, because 70% of the US economy is driven by consumer spending, that's why the markets have experienced this incredible rally. And I think that there is a lot of hope that this economic resurgence is going to continue on into next year. And why should you care? So a lot of people also ask me, you know what, that sounds great. Making money is nice. But it's not only about making money and having your money work for you. If you follow the market, it actually makes you a better employee. Now, some of you are going to go and you'll work for publicly traded companies. It's really critical that you actually tune into that company's earnings call, right? You get to hear from management. And even if you're in a legal function of a tech company and that company is public, hear what your management is saying. What are they focused on? What are the areas of the business that the investment community is asking a lot of questions about? That's really, really important for you to know. You'll learn things about your firm. You'll learn things about your division. Is this a division that your senior leadership doesn't care about anymore? And why did you pick working in it? If you work at a private company, you will likely have publicly traded peers. Knowing what they're saying on the call makes you a better employee as well. I always find it amazing how many people are presented with the ability to gain all of this information and insight, and they just really don't, because it sounds like it's an earnings call and it's finance, and why would I care? I think you do need to start listening to those from the beginning. And then also, if it's publicly traded, you should see how the stock trades. How does it react to news, and not just company news, but world news, other market news, sector news, and it will absolutely make you a better and smarter employee. Okay. So, just a couple takeaways. So definitely, I urge you, you're going to walk away with a stock that you hopefully will buy, this week or next week. I'm telling you, do it fast so you start learning more about the market. Then, I think you should never underestimate sentiment and start to really voice your opinions about stocks and the brands that you care about and follow, because your opinion, even if it's not wedded in deep fundamental numbers, it is actually, it does drive stock, and you should be confident enough to know that your opinions and what your friends feel and say about different brands ultimately can impact how they trade. And just I'll leave you with a quick story that kind of reinforces the gender stereotypes about investing and why it's in your hands to change. So, about 18 months ago, I was at a small hotel gym, and a man was on the treadmill next to me, and he was watching CNBC. And I was really excited because I was going to jog and get to watch my favorite show, which is Squawk on the Street, while I got my run in. The second I got on the treadmill, the man took the remote and he turned the TV off. And I said, "Sorry, why did you just do that?" And he said, "Oh, I don't want to bother you. It's just my stock show. Don't worry about it." And I said, "Really?" I said, "CNBC is actually my favorite channel. I watch it every morning." And he's like, "Oh, really?" So I found it to be, I think he was trying to be nice, but what it really showed me is, it's so many men have this perception that women don't care and they don't want to get involved. And it is in your hands to actually change. And the way that we change this is by embracing it early, by not being afraid to have a voice and form opinions about stocks and saying, yeah, it is for us and we're equally involved. So thank you so much for joining me today. This is my brand, theuptick.net. If you want to subscribe, and it's free to sign up. And every Saturday morning, you will get a copy of the business news written in a super accessible, relatable way. And hopefully that will help you start joining business and finance conversations as you start your post-Wellesley journey.